Mic test. Hello, good morning to all. Welcome to a brand new week, and I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. I hope that everything is fine. You guys could see my screen. So, very good morning to all. Welcome to a brand new week and a brand new month for June. So today will be the 3rd of June, 2024. All right. So, very good morning. So before we start our Daily Dose of Market Insights, let's take a look at the disclaimer first. All right. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Okay, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into the short-term intraday technical outlook for the cross asset classes for today, let's have a recap of what has taken shape over the weekend, that means i.e. yesterday and Saturday, as well as on last Friday, in terms of the key highlights, economic data releases, related news flow, and as well as the performance of the cross asset classes. So let us start with the key economic data first. All right. So for key economic data over here, let's have a quick look at the calendar. So on last Friday, we do have two key data to look out for. Will be one for the European zone, the Eurozone. So if you look at my screen over here, the core inflation rate for the Eurozone, the year-on-year, like I did mention, there is actually a risk of the core inflation trend in Eurozone. Previously, they are actually in deceleration mode, but this deceleration mode, there's a risk of stabilizing. That means, i.e., inflation deceleration stabilizing. That means there could be a chance of a bottoming out situation, which indeed it happened. All right. The consensus forecast was actually looking at a 2.8% year-on-year, a slight uptick from 2.7% year-on-year printed in April. It came in slightly higher or hotter than expected at 2.9%. So this is what I mean by the deceleration trend has started to plateau out, which indeed takes shape. All right, it plateaued out. Previously, the inflation trend in Eurozone was deceleration and it starts to plateau out. So what does it mean over here is that it could actually increases the risk of inflation trend. Instead of deceleration on the downside to hit 2%, it may just to stabilize around at the 2.7% to 2.9% level. And what does it imply over here is that ECB will be less dovish as what this market has expected throughout 2024. That means after this week of potential interest rate cut, which is pretty much penciled in by ECB officials, the next interest rate cut may not come in 2024. It will start to push down further to 2025, given the fact that the deceleration trend in the core inflation trend in Eurozone has started to stabilize right now. All right, instead of further deceleration on the downside, heading towards that 2% target, the ECB 2% target. Then now the next data I will highlight over here is the where is it? Yeah, the US PCE. So US PCE data came in within expectation. So the core PCE price index year-on-year came in at 2.8% year-on-year. That's within expectation of market is looking at 2.8% as well, and also very similar to the previous level to the previous month of 2.8% year-on-year in March. Okay, so you look at the trend of core PCE as well. Okay, it's neither up or down, it's just stabilized at the 2.8% year-on-year mark. All right, so that's for last Friday. And also I want to highlight over at the weekend over here. In the weekend, OPEC Plus has a meeting yesterday. So what is okay, it's a bit complicated. I'll try to break down step by step for you guys. So the core piece, call it OPEC Plus, pardon me, OPEC Plus is a cartel, all right, consists of Russia as well. So what they're going to do over here is that the group-wide output cuts of 2.2 millions per barrel will extend until 2025. All right, but however, the voluntary cuts were to be phased out from October this year. Okay, so basically, right, let me share with you a graph which is easier to be seen over here. All right, give me 1 minute. Okay, let me expand that graph up for you guys to see. Okay, give me a couple of seconds to load a particular graph. Because, if you look at from the words, it's very complicated. Okay, let me highlight to you guys this funnel. Okay, so what's this funnel about? Okay, good. So this is the funnel. Okay, good. All right. Okay, so basically, right, these are actually 3 layers of OPEC plus cuts that was being ironed out yesterday. So what we could have a see over here is that there's this collective group cut of 2 million per barrel plus this 1.66 million per barrel. All right, so total will be 3.66 million per barrel. So this 3.66 million per barrel will be extended until end of 2025. All right, that means 2 more years down the road. All right, now this 8-member voluntary cut. So on top of these two collective cut and this 1.66 million per barrel cut, there's this 2.2 millions per day cut. Okay, 2.2 million barrel per day cut. So this was actually scheduled to end this month. So what the group member did is they will extend it again by another quarter in Q3 2024. Then after Q3 2024, that means i.e. in September 2024, this voluntary cut of 2.2 million barrel per day will start to phase out gradually. That means from October onwards, that means from October 2024 and one year later, October 2024 till October 2025, this voluntary cut will be phased out. It's voluntary, it's not compulsory. That means, i.e., there will be a gradual increase of oil into the market. All right, but there's a big caveat, provided the economic situation at that point in time. That means, i.e., from October 2024 all the way up to October 2025, this 1 year period. Yes, even though this voluntary cut will be phased out, but it will be dependent on that economic situation at that point in time. That means this cut could come back into the market again or could be reversed, okay, depending on the economic situation. So with that, in terms of the market performance right now, we start to see oil prices actually stabilize instead after last Friday sell off of negative 0.9% ahead of the OPEC plus announcement. So what we could see over here is that oil prices do see a bit of stabilization. For the Brent crude, we see a slight gain of 0.9%, similar to the US WTI crude at WTI at 0.11% as well. Right. Then now I want to share with you. Okay, so these are the key data that took shape on release an event that took shape on Friday and as well as over the weekend. So now back to the market performance. All right, so market performance on Friday within our expectation. Those who actually follow our daily dose of market insights, I do highlight that on the short-term intraday outlook, we do see some positive element ahead of Friday US session open, and there could be a chance of a bounce, and that bounce took shape on last Friday. We see a big reversal right exactly at the 12 a.m. mark Singapore time, before this after the PCE data release. So there's a major reversal on last Friday, and very similar on Nasdaq as well. Okay, a reversal as well on last Friday, trading close to the high towards the end of the US session, and the top performer was the Dow Jones Industrial Average, up 1.51%. Okay, so all in all, right, what we could see over here is that the macro factor is now having a driver seat of the major US stock indices. What do I mean by that? Let me open up a chart so that you guys could have a clearer picture of that chart. Okay, so let me open up this chart for you guys to see. Yes, this should be the chart. Yes. Sorry, not this chart. This should be the one. Yeah. Okay, yes, this chart. Okay, so what we're showing this chart over here, right, is the intraday chart of that means the hourly chart of the Nasdaq 100, the Dow Jones Industrial Average, and S&P 500. All these are CFD prices using OANDA's platform. And what we could see over here is that this is the Friday big reversal on the Nasdaq 100 and the S&P 500 that took shape at the 11 p.m. to 12 a.m. mark on last Friday, the big reversal. And what's interesting over here is that the Dow Jones Industrial Average, is the Wall Street 30, reversed much earlier, and during the start of the US session, it started to reverse up. And what's over here is the T-Note 10 futures, which is the bond price, look at it as a T-Note 10 Treasury note prices. The Treasury note prices actually reverses upwards much earlier at the start of the European session. If you look at this little dark blue line over here on my screen. So all in all, right, if you look at the leading element that causes the Dow Jones Industrial Average, the Nasdaq 100, the S&P 500 big intraday reversal on Friday was the T-Note 10 futures prices reverse on the upside first. All right. So what causes the T-Note 10 prices to reverse is actually the slow down or the easing of the 10-year US Treasury yield from 4.6%, okay, back down to 4.5% on last Friday. So think about it is that you know that bond prices move in the indirect direction of the yield. Okay, that means if yield prices come down, bond price will move up. So this T-note US 10-year Treasury T-note Treasury note futures is something like a bond price. All right, but what I'm trying to indicate over here is that the macro factor. So US 10-year Treasury yield is a macro factor. The macro factor now is actually taking a front seat ahead of micro factor, because we know that micro factor is earnings. Earnings season is more or less over in terms of Q1, and the only Q2 earnings seasons will start in July. So the next shorter term, we talk about 3 weeks down the road, is more about macro factor. And don't forget, next week we will have the Federal Reserve meeting as well. Okay, so this is the intermarket relation I share with you all last Friday. What drive the major big reverse? I was not put major, maybe I'll put the word significant intraday bullish reversal on the major US stock indices that took shape on last Friday, that has been driven or led by the US 10 Treasury yield. Push down in yield, it gives to a push up in the T-Note 10 futures. Think of it as a US Treasury note bond price that is pushing up during the ahead of the US session on last Friday. All right, so very clearly, this is the intermarket correlation that is taking shape right now. And with that, the dollar also set back as well in our expectation. So the US dollar index actually went down. So if you look at the trend of the US dollar index, okay, it inched much lower at close at negative 0.11%. All right, at it inched much down lower, failure to break above the 105.2 level. All right, so right now it seems to be going to track within this sideways range of 105.20 at 104.20, which is close to the 200-day moving average, acting as a support level. Okay, so that actually explained to us the dollar's strength setback on last Friday, which is also within our expectation. Those for our day to follow our daily dose of market insights. All right. So that is the key intermarket we call it a linkage or dynamic that is playing out in the market right now. Oil price managed to recover, that I share with you on today's Asia session, due to a very complex OPEC plus, we call it extension of that cut. All right, in the chart that I shared to you earlier on. And also, what's interesting over here is that gold price actually didn't follow the weakness of the US dollar on last Friday. So in fact, gold price actually tumbled a bit on last Friday. So you look at gold prices on last Friday, it actually went down. Okay, it went down a fair bit, went down by negative 0.7% and retest the 2,320 50-day moving average right now. Okay, so later I'll share with you the short-term technical outlook chart again on the spot gold XAU/USD. Okay, so another news flow I want to highlight on last Friday is related to the Nasdaq 100 and the S&P 500 from a key component stock. So what's this key component stock? Is in fact Nvidia is the third biggest weighted stocks in Nasdaq 100 and S&P 500. So Nvidia right now, he's the CEO Jensen Huang is actually doing a kind of a roadshow in Taiwan right now. So he actually said that he plans for this Black Ultra higher version of AI powered chips and subsequent chips. So he actually revealed plans for annual upgrade cycle. That means right now, every year, starting from now, means 2025, 2026, there will be an annual upgrade cycle of NVIDIA chip. So it seems to me that NVIDIA right now is going back to the playbook of Apple. So if you recall that Apple almost, 1 or 2 years, there will be an annual upgrade of the iPhone. That means previously we're talking about iPhone 13, 14, 15, 16, or so on. So NVIDIA right now is also targeting the consumer side to actually state that, hey, if you guys want to increase your AI capabilities from a corporate level perspective, or you got to upgrade your server. And how do you upgrade the server is by purchasing the latest AI powered chips from NVIDIA, which is going to start to see an annual upgrade cycle. So that could potentially boost the sales of NVIDIA, but provided that the global economic situation is rosy, i.e. why? Because if the economic situation is not rosy, company will not be setting aside more funds to upgrade their AI powered data center to run these AI capabilities from a corporate point of view. Okay, so these are the news and the fundamental releases that I highlight to you on over the weekend. All right, so what other data to look out for today? For today that has been releases today is the Caixin Manufacturing PMI before the start of our daily dose today at 9:45 a.m. Singapore time. So this Caixin Manufacturing PMI, right, is in contrast to the China MBS PMI. Later I'll flash you all. So the China MBS PMI show a contraction, that means below 50, but the Caixin Manufacturing PMI shows increase, which is telling us that the deflationary spiral is slowing down in China as well, potentially, because the Caixin Manufacturing PMI consists of SME, okay, it means small medium enterprise, whilst the official MBS Manufacturing PMI that's being compiled by the National Statistics Board of China, that's a government, they don't include SME corporation. Okay, they are more consider of the middle, the bigger manufacturer, especially the state-owned manufacturer. So if you look at the trend of the Caixin Manufacturing PMI, all right, it start to rose right to 51.7 in May from 51.4 in April, and that also beat expectation as well of 51.5. And this is the 7 month of expansion, and it's the fastest pace since almost 2 years in June 2020. So if you look at the 5-year trend, it's gradually improving. Okay, that means telling us that the SME, the smaller medium-term enterprises, is now exporting out their goods, i.e. that means that it's actually either inland or overseas, both of them is showing signs of expansion. So if you look at this over here, is rather encouraging in terms of so-called negating that deflationary risk spiral in China that is being more or less being in the background is being triggered by that very still ongoing weak housing market in China. Okay, so if you look at the trend, this is the China measuring PMI. If you look at the MBS, so this is the official one. Okay, but this doesn't consist of the SME. It's still in contractory mode now on May 49.5. So you look at the trend. Okay, it's still a bit of a sideways movement. Okay, so it's a bit of a stark contrast between what we are seeing in the SME companies versus the bigger manufacturing firm in China. Okay, so now let's now straight jump to the short-term intraday technical outlook on the various cross asset classes, starting from the FX market first. All right. So now we know that the dollar strength setback on last Friday. So where does it lead us from today on the major European currency? So like with the euro dollar. So on the euro dollar over here, let me expand my screen so that you guys could see me. Okay, so yes, on the euro dollar, last Friday we do have that bullish bias. Resistance to watch on last Friday has been already been met, 10545 and 10660. Okay, so this level has already been met. Remove it. Okay. Okay, so what we're going to do over here is we will still maintain that short-term bullish but intraday bullish bias with a tightened key short-term pivotal support right now to maintain this ongoing short-term intraday bullish bias at 1.0810 level. All right, so there could be a chance of a minor pullback, okay, towards this area here. So this will be something like a first support level to watch, but I'll not put it so tight as my Titan short-term pivotal support. So potential pullback, maximum pullback 1.0810. So as long as this pullback is not surpassed on the downside, Titan 1.0810 will still maintain that short intraday bullish bias within its range configuration. Next resistance to watch will be that range top, the range top of 1.09, the all important level. Only above 1.09 potentially exposes the next near-term resistance level at 1.0925 / 1.0940, which is this congestion area over here of 13th of May. Only an hourly close below 1.0810 will invalidate today's short-term intraday bullish bias to see a much more deeper intraday corrective decline or setback to retest the bottom of the range again, which is the 200-day moving average at also acting as support at 1.0780. Okay, 1.0780 level. Okay, a break below 1.0780 exposes 1.0755 next. Okay, so that's for the euro dollar. Sterling dollar bounced up as expected and hit the resistance level that we highlighted on last Friday at 1.2660 before trading sideways. All right, so for today, we will have a tightened key short-term pivotal support on last Friday European session low at 127 figure level. So as long as any pullback didn't surpass below 1.27 figure level, we will still maintain that short-term intraday bullish bias on the sterling dollar. First resistance for sure will be at 1.2760. A break above 1.2760 brings us up to the important resistance level at 1.28 figure level, which was last Tuesday swing high, as well as this descending trendline resistance. Okay, let me put it in daily chart. All right. So this descending trendline resistance that is in place since 14th of July, also acting as a resistance now at 1.28 figure level. Okay, this line here. Okay, go down to the hourly chart. Okay, this line. Okay, 1.28. Only an hourly close below a breakdown with an hourly close below 126 figure level will invalidate today's intraday bullish bias on the sterling dollar to see a potential slide to test this 1.2 next to test the next near-term support zone at 1.2670 / 1.2610. level, which is also equivalent to the rising 20-day moving average. A break below 1.2640 exposes 1.2605, which is also confluence with the 50-day moving average. I think it's a support level as well. Okay, so therefore it's for the European currency. Now, Asia Pacific currency, let us start with the Aussie dollar first. All right, so the Aussie dollar continues to push up as expected, almost hit the first resistance, and coming close to the second resistance before it came down and trade sideways again. All right, it's now trading sideways again after hitting the second resistance at 166.80. So for here, right, it's now continue to actually involve in this kind of sideways range. Okay, a range within a range. So I'll be using the first support level to watch for today. Will be close to that 20-day moving average at 66.40 level. So I will have a tighten key short-term pivotal support at 66.20, slightly below 66.40 level. I'll put it so tight. Okay, so what I could see over here is if you do the Fibo retracement of last Friday push up, this is the 61.8 Fibo extension level as well, confluencing at 66.20. So as long as any potential dip didn't surpass below 66.20, we will still maintain that short-term intraday bullish bias within its range configuration. First resistance to watch will be at 66.80. A break above 66.80 potentially exposes 67.10, which is the minor swing high of 16th of May and 20th of May. Only an hourly close below 66.20 invalidates today's intraday bullish bias to see a further slide back down towards the range at the lower part of the range at 65.85. A break below 65.85 exposes 65.50 next, which is close to the 20-day moving average, and as well as this congestion area over here, okay, of 26th of April and 2nd of May. Okay, so that's for the Aussie dollar. Dollar yen. So dollar yen continues to actually trade below the 158 figure slash 158.30 short-term pivotal resistance level. Hit the first support level at 156.50, come break before rebounding up on last Friday. All right, so right now still no change, still using the 158 figure, 158.30 as my short-term pivotal resistance level. All right, still having that short-term bearish bias intraday. First support level to watch 156.50. A break below it exposes 155.90, which is confluencing with the rising 20-day moving average, I think as a support level as well, closely, and as well as this minor ascending trend line from the low of 3rd of May. Only an hourly close back above 158.30 will invalidate today's intraday bearish bias on the dollar yen to see a squeeze up potentially to retest the 159.50 slash 160.30 long-term pivotal resistance zone on the dollar yen. And also right now, right, the JGB yield is actually also supporting or capping dollar yen strength from appreciating. Why? Because of the via the carry trade conduit. So you look at the 10-year JGB yield, it continues to rise, all right, at 1.070 level. Okay, didn't actually do any major setback. So right now, this level is actually the highest level. If you do go to the weekly chart, right, it's the highest level since 1.07. Okay, so you go to this level here. Okay, it's the highest level since July 2011. Okay, so that's about close to a 13-year high. All right, so very similar if you look at it on the chart of the 30-year JGB as well. Okay, which is at 2.24%. So that is the highest level since April 2011. And what you could see is the one that is rising at the steeper rate is the 2-year JGB yield. Okay, at 0.4%. See here, 0.4%. So this is the highest level, okay, since April 2009, much more steeper. All right, so net all in all, what it means that over here is that a very steep rise in JGB yield. That means yield are considered as cost of funding. That means if I were to be a carry trader who previously using the carry trade as my strategy to actually borrow in Japanese yen, I mean short yen, long dollar, this particular carry trade strategy will be getting more costly and less attractive. So with that, that could imply that the dollar yen rate, the dollar yen appreciation will be kept in check due to this potential rising JGB yield that doesn't seem to be showing any signs of stopping at this point in time. Momentum is rather strong. This is the 20-day momentum of the 10-year JGB yield. There's no bearish divergence at all, similar to the 20-day rolling momentum of the 30-year and the 20-day momentum of the 2-year JGB yield. All right, and if you look at from a relative performance perspective, that means taking into account of the spread of the US 10-year Treasury note yield minus the 10-year JGB yield is also inching downwards as well. Doesn't seem to be supporting further dollar yen strength. That's for the 10-year. And if you look at the 2-year, okay, is inching downwards as well after that hitting that pullback resistance of 4.62. That means this is the spread between the 2-year Treasury yield minus the 2-year JGB yield. Okay, so looking at the JGB yield intermarket dynamics, it doesn't seem to be supporting further dollar yen strength. All right, so this gives me the reason why I still maintain that short-term intraday bearish bias on the dollar yen. Okay, taking into account of the movement of the JGB yield. All right, so that pretty much sum up the FX short-term intraday technical outlook for today. Based on the current intraday technical elements, potentially there could still be a continuation of the short-term intraday dollar setback narrative. Now, FX market has been done. So now move on to the stock market. So we share with you all that bullish intraday movement on the US stock indices as they having a positive feedback loop across the world. Okay, let's start with the Japanese market first. The Nikkei 225 or the Japan 225. Still recall that on last Friday we have the neutrality range. So price action broke above the upper neutrality limit around the 38,300 level, pierced up higher, surpassed both the 20-day and the 50-day moving average, and now hitting the all-important first resistance, the range resistance. Previously, there was a failure breakout on 29th of May, and right now there is doing a slight minor setback as well over here. So what we could see over here, very interestingly, right? Previously, it tested this failure breakout of 38,975, and during the test of that failure breakout, the RSI shaped a bearish divergence. All right, and right now this test on it again, there is no bearish divergence. Instead, the price action now moving hand in hand with the price action despite hitting the overbought level. So it indicates to us that this momentum is not weakening at all. Based from last Friday push up, clearing above the 20-day moving average, and right now during the Asia session clearing above the 50-day moving average. So with that positive reading or momentum reading as seen on the hourly RSI, we will flip to a bullish intraday bias for today on the Japan 225, i.e. the Nikkei 225, using last Friday low as my short-term pivotal support level. You could see this level very clearly, this congestion area, broken, retest, shape that V-shape push up. So 38,290. So there is actually a first support level to watch that is slightly higher at this level here, 38,060. So as long as this minor pullback didn't surpass below 38,290, we will still maintain that short-term. We will flip to a short-term intraday bullish bias on the Japan 225. A breakup. First resistance will be 38,975. A break above 38,975 exposes the next resistance area, near-term resistance at 39,500. Pardon me, a bit of tongue twisting, which is the 20th of May minus swing high. Only an hourly close below 38,290 will invalidate today's intraday bullish bias on the Japan 225 to see another round of very messy, choppy corrective decline again to retest last Thursday swing low area at 37,750/600. A break below it exposes 37,105. All right. So before we jump into the Hong Kong 33, one more longer term chart I share with you is this the daily chart, the Nikkei 225, which is so very positive as well. What we could see is after the test on last Thursday with a bullish hammer right at the major ascending channel support level from the low of 31st of October, price action did a positive move on last Friday. So this is something like a bullish morning star candlestick formation, taking into account of 3 candlestick, 1, 2, 3. All right, and today there's a positive follow through. Now it's testing at the 39,960/975 level, right, on the hourly chart. Okay. Now, Hong Kong 33, which is the Hang Seng Index. Still recall on the Hang Seng Index on last Friday, we do have that bearish buy, intraday bearish bias below 18,570, looking for the push down to retest this low on last Friday. Last Thursday low at 18,150 has been made before rebounding right now, and right now the price action is now shaping that bullish reversal candlestick in today's Asia session. But what's interesting over here is that the Hong Kong 33, despite shaping a lower low on last Friday, the price action on the hourly RSI has shaped a higher low, indicating to us this momentum that was seen on last Friday has started to ease off by the appearance of that bullish divergence on the hourly RSI. So with that bullish divergence on the hourly RSI and coupled with the very strong bullish reversal that was seen on the major US stock indices, coupled with the dollar strength setback story that is still potentially still intact, as expressed by the short-term intraday bullish outlook that I shared earlier on the major dollar pair, we'll be flipping to a short-term intraday bullish bias on the Hong Kong 33 using 17,895 as my short-term pivotal support level, slightly below the 18,154 level, 150 level, which is the first support right now. So what's 17,895 level? Okay, this minor congestion area here is in fact the 50% Fibo retracement of that last rally from 19th of April all the way up to 17th of May. Is the 50% Fibo retracement level. All right. So as long as this 17,895 short-term pivotal support holds, we will flip to a short-term intraday bullish bias on the Hong Kong 33 level. Hong Kong 33, a breakout above 18,560 exposes the next near-term resistance level at 18,980, followed by 19,210 level. All right. Only an hourly close below 17,895 will invalidate today's short-term intraday bullish bias on the Hong Kong 33 index. Potentially there we will see the extension of this minor corrective decline to expose the next near-term support level at 17,600, which is the rising 50-day moving average. Below 17,600 exposes the 200-day moving average, which is also confluence with the graphical support at 17,170. That's Hong Kong 33. German 30 rallied as expected and hit the two resistance level that we had on last Friday, 18,530 and 18,640 level. All right. So right now, this 18,530 level will be the first support level to watch. So I don't want to put it so tight at 18,530 level because it hasn't surpassed the 18,640 level. So this will be something like a first support level to watch in a potential pullback. Why? Because the RSI really hit the overbought level. So as long as this pullback didn't surpass last Friday low, which is at 18,405, so this will be my Titan key short-term pivotal support. 18,405, we also confluence with the rising 50-day moving average as well, and also this 18,405 now is also corresponding to the major ascending trend line support level, major ascending trend line support that I drew from the low of 18th of January 2023. Okay, back to the hourly chart. Okay, so where is it? Let me expand. Okay, so still maintain that short-term intraday bullish bias for today on the German 30 above 18,640 exposes 18,845/925, which is the current all-time high area over here. only an hourly close below 18,485 will invalidate today's intraday bullish bias to see another round of minor corrective decline structure to unfold to expose the next near-term support level at 18,320, which is the minor swing high area of former minor swing high area of 24th of April. A break below 18,320 sees the extension of the minor corrective decline towards 18,175 next, which is the minor congestion area of 3rd of May and 7th of May. Okay, so that's for the short-term intraday outlook on the German 30. So still maintaining that bullish bias with a tightened key short-term pivotal support at 18,405. Now, what's next for the US Wall Street 30? So US Wall Street 30 managed to hit our resistance zone at 38,415/550. Okay, this level. Okay, so this level now will be delete. Let me delete this level. Okay, so now this level will be something like a pullback support level to watch for today. Okay, 38,415 level. Okay, maybe it's a, let me put it as a zone. Okay, 38,540, 38,415 is a zone here. So this will be like a pullback support level to watch. Why pullback? Because the hourly RSI is at a grossly overbought level, but no bearish divergence. So potentially we got pullback. So right now we will do have a tightened key short-term pivotal support level for that pullback. Maximum trajectory for that pullback, which is at 38,190. Okay, 38,190. Graphical level as well, former resistance break turns to a pullback support. And if you look at last Friday's push up or short rally, that is the 76.4 Fibo retracement level. Okay, so as long as this pullback didn't surpass below 38,190, we will still maintain that short-term bullish bias intraday on the US Wall Street 30, i.e. the Dow Jones Industrial Average. Next resistance to watch will be at 38,970/39,130, which is close to the 20-day moving average. Above it exposes the next resistance at 39,390, which is the former minor swing low, broke down turns to a pullback resistance right now. Okay, and if you look at the top side from the current all-time high to the previous low, that decline is also close to the golden ratio as well of 61.8%. Okay, that 39,390. All right, only an hourly close below 38,190 will invalidate this short-term intraday bullish bias on the US Wall Street 30 to kickstart another round of minor corrective decline to expose the next support area at 37,890/750. Below it exposes the minor swing low of 19th of April at 37,380. Okay, then for the Nasdaq 100, a bit of whipsaw over at the short-term pivotal support that we highlighted at 38,340 before shipping that V-shaped recovery again. All right, so what we could see is that bullish divergence that's being flashed out on the Nasdaq 100 level as well. And what we could see is after that we do have that bullish breakout. Okay, on last Friday. Okay, break retest. Okay, so with that we will actually maintain that 18,350 as my short-term pivotal support level for today. So as long as any pullback didn't surpass below 18,340, still maintain that short-term bullish bias narrative intraday on the US Nasdaq 100. Resistance to watch for today will be at 18,720, followed by 18,830. So two resistance level to watch: 18,720, 18,320 level. Only hourly close back below 18,340 will negate this bullish tone to see a messy slide to retest the 50-day moving average that's acting as a support level at 18,100. Okay, only a break below 18,100 will see a deeper corrective pullback to expose the next support at 17,810 level, which is the former minor swing high of 29th of April, now turns into a pullback support. All right, so net overall, the short-term technical elements are still positive, so we'll still have that short-term intraday bullish bias on the Nasdaq 100, the Wall Street 30, the German DAX. And for the Asia Pacific currency indices, the Japan 225 and the Hong Kong 33, we will flip to a short-term intraday bullish bias for today. Okay, now what's cooking for the spot go XAU/USD? Let's look at the technical element chart for spot go. Okay, so now spot go now is actually playing with this, it's now retesting this 38,320 level over here. Okay, this mark over here. So with that, it seems to me that this price action is rather weak right now. So given the fact that it didn't have a clear breakdown below the 50-day moving average, is kind of testing it. So with that, right, I will have this, the last Friday low is 2,320 level. Okay, so with that, I will have a, because it's very mixed element right now. So in short term, I will have a neutrality stance. Okay, kind of go sideways in short terms. 2,320. Okay, this level here. Okay, so on last Friday, right, we were bullish, so it can't clear above the first resistance at 2,360 before coming back down again, and this 2,360 is the 20-day moving average. Okay, so given it starts to form a lower high, lower low, but still can't break very clearly. There's no clear breakout yet of the 50-day moving average, but it's an hourly candle. It's still hourly chart. So as long as it can have another break below last Friday low, then we will flip to a bearish bias to expose the next support area at 2,307, which is the minor swing low of 8th of May and 9th of May. Below it exposes the key medium-term pivotal support of 2,280/2,260. So for now, neutral between 2,320 and 2,340. Okay, so this is the very tight range to watch out for today for spot gold XAU/USD. Then for WTI crude oil price, so what we could see over here is that last Friday we were neutral between this 70, this level here, 80, 90, 81 and the 76.70 level, which is the minor swing low of 15th of May and 24th of May that managed previously staged that bounce. So what's interesting over here is that price action came down, it sold off during the US session, and today managed to do a bit of recovery right now, expose OPEC Plus meeting. So what you could see over here is that sell-off on last Friday give rise to a bullish divergence that is being seen on the hourly RSI. So with this bullish divergence, some kind of positive elements indicate to us that last Friday's momentum seems to be easing off. The sell-off of last Friday momentum seems to be easing off. So with that, for sure, this is a key range, is at the lower limit of the key range configuration. So I'll be using the lower limit of that key range configuration, which is 7670, as a short-term pivotal support for today. So flipping for a short-term bullish bias intraday towards the upper limit of the range. So first resistance to watch will be the 20-day moving average, now acting as a resistance at 78.95, followed by this congestion area here, 79.40. Okay, so this level here, unless it could break above 79.40, then we could see 81 figure, 81.70 coming into play for West Texas Oil. So these are the levels to watch. But however, if we start to see a breakdown below 76.70, that means an hourly close below 76.70, then this short-term bullish bias within a range configuration will be invalidated to see the extension of this ongoing corrective decline to expose 75.50 next, which is this graphical support over here. A break below 75.50 exposes 74.20 next. All right, this area here. Okay, so that's the key levels to watch out for West Texas Oil, using 76.70, the lower limit of that key range configuration, for a short-term intraday bullish bias within a range, but within a range, then resistance to watch for today will be 78.95/79.40, which is close to the 20-day moving average. All right, so before we go, what are the key data point to look out for today, the key economic data to look out for today? So today's key economic data will be the US session, very important. Why? Because of this ISM manufacturing. So for US, right, the market participants will focus more on the ISM manufacturing PMI rather than the S&P manufacturing PMI. This traditionally, don't ask me why. Okay, that's the traditional focus by the market participant. So for the manufacturing PMI, right, almost unchanged, right? The market participants are still looking for a contractionary condition in the manufacturing sector in US. So they are looking at only a slight movement up to 49.8, but not 50. So market is expecting 49.8, only a slight uptick to 49.2. So if you look at the trend of the manufacturing PMI, okay, it's kind of hovering lackluster, okay, kind of flattish over here, but showing a slight improvement, okay, just a slight improvement. Okay, but still below the 50 level mark. But the indicating on the highlight is the manufacturing prices. So these are the input prices as per survey. So if these manufacturing prices keep rising, the input prices keep rising, it means that the manufacturers in US is expecting input costs to rise. That could actually lead to so-called a very not so encouraging signs for the Fed to be very aggressive on their interest rate cut, because of input prices rising. It could actually lead to a uptick in the US inflation number as well, because this is considered as a cost of business. All right, so if a cost of business rises, businesses could pass on prices to consumer. So you look at the manufacturing prices or input prices by manufacturers, 60.9 previously, so consensus is still expecting 60, okay, almost unchanged. So you look at the trend, okay, it's also gently rising upwards as well. Okay, there's a big rise. It's not gentle, it's a big steep move up over here. So market is expecting 60 level today, all right, for the month of May. Okay, for the month of May, expecting at 60. Okay, so something to look out for. So this data will be releasing at half an hour after US session open, 10 p.m. Singapore time. So with that, that will be a pretty quiet session. No more Federal Reserve officials speaking for this week, because they're now in the blackout period ahead of next week FOMC meeting. All right. So with that, do have a great day ahead. This is Kelvin here signing off, and we shall speak again tomorrow. Thank you.